Thank you very much to the organizers for including our paper in this great conference. This is joint work, as Martin was saying, with Pablo Ottonello from Michigan and Paolo Varraso, who's a fantastic graduate student here at NYU. He's working in international macro, and he will be on the job market not this year, but next one. Our motivation for this paper is that there has been a paradigm change in the last decade related to the use of capital control policies. Central policy institutions like the IMF and the World Bank are now open to the implementation of macroprudential policies, especially when these are aimed at curbing excessive borrowing and controlling financial instability. In fact, currently, capital controls are part of the standard policy toolkit used by many emerging market policymakers across the globe. This in turn stands in sharp contrast to the predominant view or the consensus prior to the global financial crisis. The view around there, which is captured in the broad notion of what was labeled the Washington Consensus, argued that these type of policies impeded the flow of capital to where it was mostly needed. So this change at the core of this changing paradigm, there was large advances in academic research in the study of inefficient borrowing arising from financial frictions. The first building block in this literature was mostly theoretical and basically studied inefficiencies in incomplete markets models and models with pecuniary externalities stemming from collateral constraints with prices on them. The second building block was mostly quantitative, and this set of papers argued that the implementation of state contingent taxes on debt can actually reduce significantly the probability of economies experiencing financial crisis and sudden stops, and also improving significantly the welfare for these economies. So what we do in this paper is study a dynamic incomplete markets model of a small open economy with a general formulation of these collateral constraints. Our main finding is that the desirability of macroprudential policies depends on the specific form of collateral used in debt contracts. In particular, in economies that in which collateral is valued at the time in which debt needs to be repaid, that is collateral valued at future prices, we argue that the competitive equilibrium of those economies is actually constraint deficient. This stands in quite contrast with the well-known result of inefficiencies in economies in which collateral is valued at current prices. Later in the paper, what we do is we actually argue that it's hard to distinguish between these two model specifications. That is, models in which collateral is valued with future prices, in which the debt is due, or models in which collateral is valued at current prices, is actually challenging on two main grounds. The first one is that actually both types of model specifications rest on plausible microfoundations, and I'll walk through those. The second is that the quantitative properties of both specifications are such that they can account for the main data features on business cycles on emerging markets. This leads us to our takeaway from our analysis, which is that we think there is value in the provision of direct empirical evidence on both the policy transmission and the microstructure of debt contracts and the valuation of collateral. So here's the outline of the talk for the rest of the talk. I'm gonna first walk you through the model environment, the baseline model environment, and then go through the main result, which is casted in one theorem, and go through the sketch of the proof. Then I'll actually argue that it is hard to distinguish between these two models based on its microfoundations and its quantitative properties. And later, I'll go through an extension in which we analyze also models with capital-based collaterals rather than income-based collaterals. So here's an overview of the baseline model. We're gonna start with a canonical incomplete markets model of a small open economy with tradables and non-tradable goods. This is going to be an endowment economy in which the endowments of tradables and non-tradable goods are going to be subject to aggregate risk. So we're going to be working with a representative agent here. The markets are incomplete with one period risk-free debt in which the representative household can save or borrow. And we're going to introduce financial frictions via collateral constraints that are linked to the value of income. As I said later, I'm going to extend the analysis to allow for collateral linked to the value of capital, as this has been mostly studied in the macrofinance literature. So here's are the households features. The households have preferences over lifetime utility of a consumption aggregator, which aggregates consumption of tradables and non-tradables. The endowments will follow a Markov process. These are the aggregate endowments with a bounded support. And the budget constraint for the households is the following. We're going to have that the value in terms of tradables of consumption plus debt repayments needs to be equal to the value in terms of tradables of the income of the households plus debt issuance. Implicit in the writing of this budget set, there are a couple of assumptions. First one is that the assumption, sorry, is that actually the debt is denominated in tradables, in tradable goods, which in this real model, which would map to something like a foreign currency. There are two relevant prices in this economy. One is going to be the relative price of non-tradable goods, which we denote PT. That's going to be endogenously determined to clear markets, the goods markets in equilibrium. And I'll walk through the equation that determines that. And the other one is the debt price, or the risk-free interest rate, which, following most of the literature here, we're going to assume that it is priced by deep pocket foreign investors, and that's their discount rate. An important part of the model is how we're going to think about collateral constraints. So we're going to adopt a general formulation by which there is a maximum level of debt that these households can take, which we're going to assume is a function of potentially the whole sequence of future relative prices of the non-tradable goods. So that's a quite general formulation, which will nest two commonly used particular cases in the literature. One is what we label current income as collateral, in which this D function will be a potentially time-varying fraction of the value in terms of tradables of the income of the household. A second one is what we label next period income as collateral, in which the maximum level of debt is capped by the value, again, potentially time varying, of the income measured in tradables of the household at the time in which the debt is due. Of course, this income is stochastic because there's risk. So if we impose that these constraints needs to hold for all states tomorrow, then it is equivalent to imposing that the tightest constraint is going to be that one from the minimum possible realization of the income tomorrow. Again, this does not rely on this minimum assumption. We could put something like in here, like an expected value, and our results go through. Note that this second collateral constraint captures the spirit of the Kiyotaki and Moore original paper, in which in this case, they were using capital instead of income as collateral. So the competitive equilibrium in this economy is characterized by four key equations. The first one is what the intratemporal optimal allocation between consumption of tradables and non-tradables given by the households. What that gives us is an expression for the relative price of the non-tradables, which will be such that actually it will be an increasing function of the tradable consumption today. So higher tradable consumption increases aggregate demand, which increases the relative prices of non-tradables. This feedback is something that the planner would like to exploit in certain cases. The second equation that characterizes equilibrium is the Euler equation for tradable goods. This Euler equation also has a Lagrange multiplier associated to the borrowing constraint. And the third key equation of equilibrium is the complementary slackness associated to the borrowing constraints, which implies that either we are in two cases, or the Euler equation holds with equality, or actually the borrowing constraint is binding. The last two equations that characterize equilibrium is the market clearing for not tradable goods, and by Varraso, we get the aggregate resource constraint, or the market clearing for the tradable goods, which is given by this. So we then consider a social planner. The social planner has the following instruments. So if we're gonna consider a social planner that has the ability to tax households' borrowing. So it's gonna be able to have a proportional tax on households' debt holdings choices. We're gonna also assume that the government is benevolent, and importantly, we're gonna assume that the households lacks commitment. With those three assumptions, then we can write the social planner problem in the following way. The social planner is going to choose directly allocations, consumption, and choices. And the choices we're assuming implicitly already in here that market clearing for non-tradable goods. So it's going to maximize the utility subject to what? The resource constraint, the borrowing constraint, in which the planner takes into account the fact that this price is indeed a function of the consumption allocations of the households, and the equilibrium expression for the price, which is basically this one over here. So in a way, it's as if the households are choosing optimally, still choosing optimally according to the intratemporal condition, the split between consumption of tradables and non-tradables. The lack of commitment is shown, is basically captured by the fact that the planner takes as given the future policies, this function C, T plus H. And in the Markov equilibrium, there's going to be a fixed point between these future policies and the actual policies that solve this problem from the one period deviation. Note also that the Euler equation does not appear as a restriction or as an implementability condition, because the way we can solve this model is consider the relaxed problem without the Euler equation, and then just use the taxes on debt to set them appropriately so that the Euler equation holds with equilibrium at each state and time. So here's our main result that we're fleshing out from the paper, which is the efficiency with future income used as collateral. What we show is that under center regularity conditions, differentiable policies and consumption being decreasing in debt, then we have the following, which is if the borrowing limit is independent of current relative prices of non-tradable goods, in our general notation, if the function D, the derivative of the function D with respect to current prices is equal to 0, and nothing else, we're not imposing anything about future prices affecting D, then what we have is constrained efficiency in the equilibrium, meaning that the solution to the competitive equilibrium and the solution to the social planner's allocations coincide. So let me go through the sketch of the proof for the one particular case, which is the one about next period income used as collateral. In this case, what we have is the approach to actually showing the equivalence between allocations of social planner and competitive equilibrium will be one in which we inspect the first order conditions and we actually note that they are equivalent to each other than the how the multipliers associated to the borrowing constraints are affected. So here is the Euler equation under the competitive equilibrium, which, as we said, we had a multiplier associated to the borrowing constraint. And below, I'm showing the social planner's first order condition associated to the Euler equation, sorry, for the case of the social planner. Note that in here, what we get is we can show a one-to-one mapping between the multiplier and the competitive equilibrium and a rescaled version of the multiplier under the social planner's problem. And it is easy to see that when this multiplier is 0, this multiplier will also be 0. And when this multiplier is positive, this multiplier is also positive, since we can show that what's multiplying the multiplier of the social planner's problem is indeed what the planners would like to affect the borrowing constraint, the channel through which the planner would like to affect borrowing constraints, which is debt choices affect consumption of tradable goods in the following period, which in turn affects the prices of non-tradable goods, which in turn affects the borrowing constraint. So we can show that this is indeed positive, which kind of obtains our one-to-one mapping of these multipliers. The intuition is the following. What this result is saying is that under future prices, the planner does not want to intervene by taxing debt. And the intuition is the following. Consider first two cases, right? One is, would the planner like to intervene when the collateral constraint is binding? Okay, so when the collateral constraint is binding, let's assume that this guy is positive. Basically, what the planner would like to do is relax today's borrowing constraints. But how does it relax today's borrowing constraints? It kind of needs to increase tomorrow's prices of non-tradable goods. And that's done by saving today and increasing consumption of tradables tomorrow. But that's exactly at odds with the original intention of the intervention today, which is to foster borrowing in a period in which the constraint is binding. So there's no room for intervention when the collateral constraint is binding. The other thing that we may also ask ourselves is whether there is room for intervention on a period before in which the collateral constraint is not binding, but there is a positive probability of it being binding in the future. In that case, what the planner would like to do is relax the collateral constraints tomorrow. But that's being done by potentially affecting consumption of tradables, not in the following period, but in the period after that. And just trying to implement policies today to affect the consumption in 2 periods from now is time inconsistent, in the sense that whatever the planner would like to do now, the future planners wouldn't do that in the optimal way. So there is no room neither to implement policies in a crisis time when the collateral constraint is binding, nor in a period before. This is a thought. This is not what the result comes through in the case of current prices in the collateral constraint. So here what we're showing is that the mapping that I was telling that exists between the multipliers of the competitive equilibrium and the social planner fails to exist, that one-to-one mapping fails to exist under current prices. So how do we see that? This is the same first order condition, same Euler equation under the competitive equilibrium, and this is the Euler equation for the social planner with current prices. Note that with current prices, debt choices affect not only consumption today, but consumption tomorrow, which means that it will affect the borrowing constraints today and tomorrow. That implies that the mapping that we used to have between the competitive equilibrium multipliers and social planners multiplier fails to exist. There's no longer that one-to-one mapping, right? And in particular, it's easy to see, and this has been done in previous papers, that even if the multiplier on the competitive equilibrium is equal to 0, there is still room for policy due to this term over here, which is the policymaker, the social planner, would like to prevent curb borrowing today, to increase consumption tomorrow. That will relax the borrowing constraint by increasing the relative prices of non-tradables tomorrow, which in turn will allow the household to borrow more in the period in which they are capped by their borrowing constraint. So that's kind of like the main result. What I'm going to do now is actually try to argue that it's challenged to distinguish between these two models on the grounds of microfoundations and competitive and quantitative properties. Let me first go through the microfoundation of the future income as collateral. How can that model be microfounded? Well, actually, to microfound that model is kind of straightforward from the tradition of Eaton-Gersowitz type of models, in which the borrower can have the ability or the choice to default or repay on its debt when the debt is due. So just consider these kind of like same Eaton-Gersowitz type of model, but with the following features. This is the value of repaying the debt for a household. And suppose that there is no punishment. I'll talk about that. So basically, the value of repaying is just repaying the debt and then having the option to default in the future and issue on newly issued debt. The value on defaulting, well, let's assume that the only punishment associated to default is that now the lenders can seize a fraction kappa of the value of current income. This is for an individual agent deciding whether to default or repay. And if there is no punishment in other than that one, meaning that the household can still issue debt and default potentially on the next period, then it's easy to see that these two values only are different in the sense that this one has to repay its debt and this one faces a lower income. So it's kind of easy to see that the default decision will be just boiled down to a static comparison between this DT and kappa times the value of income. Then how do you ensure that default does not occur in equilibrium? Well, for example, it is easy to see that if for the lender you assume sufficiently high cost of default, then you're gonna get a kinked price of debt such that actually the price of debt is the international interest rate up to the borrowing constraint, up to the level in which you did the borrower defaults, and then infinite or something that will dissuade the borrower to choose those levels of debt. In the case of current income as collateral, the microfoundation rests on default by borrowers requiring fraud in the borrowing period, fraud being perfectly observed by lenders, and if the lenders observe this fraud, then they can still seize the fraction of kappa of the current income. So let me now go to the second part of distinguishing between these two models, which is the quantitative analysis of both models. So what we're going to do in here is we're going to calibrate our model to Argentina at an annual frequency. We're going to use CRRA utility functions, a CES aggregator between tradables and non-tradable goods with a weight omega on tradable goods. And we're going to estimate VAR on the endowment processes from the data on sectoral output from Argentina. We're going to pursue two calibrations, one for current income as collateral and another one with future income as collateral, and set a subset of parameters common across those two calibrations, the standard ones like risk aversion, intertemporal elasticity of substitution, the foreign interest rates, and the endowment process. For the current income as collateral calibration, we're going to set the discount factor, the share of the income seized by lenders in case of default, and the share of tradables in the CES aggregator to match key three moments, which are the level of external debt in Argentina, the frequency of sudden stops, those defined as periods in which the collateral constraint is binding and that this leads to a capital outflow that exceeds one standard deviation, and the share of tradables in GDP of 32%. For the case of future income as collateral calibration, we're going to pursue a similar calibration strategy to the current income, but with one addition. We need to introduce shocks to kappa, to the fraction of income that is seized. The reason is quite simple. In this model in which you have the minimum value of income capping the constraints, then you're not going to observe fluctuations in that maximum level of debt that you can obtain. That is in the opposite spirit of the current income as collateral. So in order to introduce fluctuations in the borrowing constraints, we introduce these kappa shocks as has been done by some other papers in the literature. And we're going to do so in the simplest way by assuming a two-state Markov process with a sufficiently high kappa such that the constraint is never binding, and a tight kappa which we match together with the discount factor and the share of tradables to match the same three moments. Then what we show is that basically both models, and in particular the future model, can account for the same data features, the main data features of business cycles in emerging economies, as excess volatility of consumption and countercyclicality of the current account and the trade balance. So that leads us to conclude that neither from a theoretical standpoint nor from its quantitative properties we can tease out in a straightforward way these two models.
Diego, can I ask a quick question?
Yes, Enrique, of course.
So this previous slide when you showing the results, so how do the two models differ in terms of actual sudden stops in the model?
So the sudden stops in the model, in the second model, are mostly generated by a shift in the kappa. Because basically that's what triggers the tightening of the constraint.
But put them against the data. That seems to be a big difference between the two models, right? I mean, the other model doesn't need the shocks to kappa.
That's true. That's true. I completely agree with that, Enrique, in the sense that the other with the, so just to be clear, the model with future incomes as with future prices in the constraints and no kappa shocks will not be able to generate counter cyclicality of the current account, neither the presence of sudden stops. The question then is whether the data can be actually generated just by shifts in income or by joint shifts in income and in kappa shocks. And what we're saying is that we don't have, at least from our standpoint, we don't have any reason to believe that either or is a better model than the other.
Okay.
The last thing that we do is we extend the model to analyze capital-based collateral constraints. So what we do is we implement a similar framework with just now supply side, so a production of a single tradable goods, which is neoclassical on the supply side. Say it again, Martin.
3 minutes.
Yeah. So what we're gonna assume is that firms produce a single tradable goods with capital and labor, and we're gonna assume for simplicity that the inputs of these two inputs are on fixed supply, and we're gonna assume segmented markets in the sense that the capital is priced by households and debt is priced by foreign investors. So we're gonna again assume that households now can borrow against the value of the physical capital. And we're gonna consider two types of constraints: capital valued at current prices and capital valued at future prices. So the same logic that I was talking for the income-based model carries through the capital constraint model. The only difference in here is that now we have an extra Euler equation, which is actually the Euler equation for capital, which gives us in the competitive equilibrium the equilibrium price for capital. And then we have the competitive equilibrium Euler equation for that and the social planners Euler equation for that. We still observe the one-to-one mapping between these multipliers, provided that the asset prices increases with consumption. In that case, we still have the same multiplier. So let me just now wrap up. What we show in the paper is that policy prescription of quantitative models depend on the specific form of collaterals. Collateral constraints linked to current rather than future income prescribe interventions, but collateral constraints with future incomes do not. In both cases, that one important thing that to clarify is that both cases, both types of models deliver predictions that macroprudential policies do indeed curb borrowing and reduce the occurrence of financial frictions, of financial crisis. And then our takeaway is that there may be value in providing empirical research to help guide these models, for example, by providing a characterization of the microstructure of borrowing contracts and how collateral is valued, and also on the transmission of these models, meaning how policy affects collateral. Thank you very much.